Hello class, this is Dr. Fenton. In this video, I'm going to cover the content of Chapter 1 for your Accounting 200 course. To do this, I'm going to go through the e-textbook that's in your Connect account and explain the material within the chapter and also explain the examples given in the chapter. So I want you to look at this video. Hopefully it will help you understand Chapter 1, but please don't use this video as a substitute for not reading Chapter 1. Please read the textbook yourself. Read it word for word and follow the examples and the numbers through in the textbook. Hopefully that'll help you better understand the material. So let's get started. Here we have Chapter 1 in the e-textbook. Now McGraw-Hill calls this the e-book, and you can find it by clicking on Library in your Connect account, and then when you go to that page, click on the e-book symbol here and you should come up with Chapter 1. If not, you can go to Book Contents and find it, or click these arrows to jump from section to section. So here is page 2 of your textbook, and this is just like the hardbound edition of your textbook if you have it. So let's look at the next section. Here we have sort of a background information about accounting, and this shows you that accounting is often called the language of business. And so what we do in accounting is, of course, record the dollar amounts of all the activities we're dealing with, get those recorded in the correct accounts, and then prepare statements at the end of the accounting period so we'll know how well we did during the period. Did we have a profit that shows up on the income statement, or was it a loss? At the end of the period, for the balance sheet, we can show the assets that we have and the liabilities and the equity accounts. We'll get to those statements a little bit later on, but again, accounting is something that everyone is concerned about in business. Whether you are the accountant or not, and most of you will not be the accountants, you still need to understand the numbers so you know if you are a marketing person, how much of a budget do you have to spend for advertising? Has it been effective? So you'll need accounting information to really handle any type of decision making in business. Now, who needs this information for decision making? Well, investors. Do they buy the stock or sell the stock? Creditors, do they loan money to the business or not? Customers, suppliers, managers, of course, to make decisions on a daily basis for the company, even employees, and then you can see the others down through here. On this page, it shows you that we're going to talk about financial accounting in this course. There are two types of general accounting. There's managerial accounting and financial accounting. And in this course, we're going to cover the financial accounting part of this. This will be us preparing the numbers to present to people outside the company as well as inside the company, managers. But this will be for the investors and the creditors and, for the tax authorities. Scrolling on down through the pages, we see here a little example starts. And this says, page 5, starting into page 6, that if you need to raise $35,000 to get a business up and running, then what you might do, as they have in the example, you might sell 1,000 shares of stock. That'll raise $25,000. Then you might, it shows you who you sold it to. Then if you raise $25,000 by selling stock to various people and yourself, then you borrow $10,000 from a local bank. That gets you $35,000 into the company. That's how much cash you have. Then you use some of the cash to buy some equipment. So what you're doing is taking one of your assets where you did have $35,000 in cash, and now you're using some of that cash to buy equipment. So after that purchase, you have equipment, $24,000 in the equipment account because that's the cost of your equipment, and now you only have $11,000 remaining in your cash account. So your cash balance went from $35,000 down to $11,000 when you purchased $24,000 of equipment. Now on the other side of the balance sheet, we'll look at the balance sheet in detail in just a minute, but on the other side you'll have liabilities, which shows you that you owe the local bank $10,000. Then you have $25,000 that shows this is how much money the investors put into the business, $25,000. So on the balance sheet, again, we're going to see this in a minute, your assets will always equal, up here your assets, your resources, will always equal what they call claims to resources, which will be your liabilities and your equity. Some more definitions going through here. I'm sure most of you know what a corporation is. You file your articles of incorporation with the Secretary of State. You'll get a corporate charter, and now the business is a separate legal entity. There is limited liability to the owners, to the stockholders. So that's one reason a lot of people want to incorporate, because as the owner of the business, the stockholder of the business, they are not personally liable for the actions of the business itself. Again, you need to make sure you handle everything correctly legally, but that's the hope that we have. There is a sole proprietorship. That is a one-owner, non-incorporated business. A partnership is where you have two or more owners, and you could have thousands of partners if you wanted to, but two or more owners, again, non-incorporated. Scroll down to the next page. We start talking about assets and liabilities and equity. So make sure you read through this. The resources a company has that can be used in a business, those are referred to as assets. It'll be cash. It'll be equipment. We're going to see later on it's going to be accounts receivable. It's going to be inventory, supplies, building, land. So all these are resources, and these are called assets for the business. Liabilities, as you already know, you owe someone some money. So whether it's to the bank, to the utility company, maybe you owe your employees some salaries, those are all liabilities. Equity is where we show the owner's investment in the company. So if you started a corporation and you sold stock, you will see how much the owners invested in the company in this section. Also, you're going to see in this section in a few minutes where we're going to add to the stock, within the stockholders' equity section, something called retained earnings. And those are the earnings generated by the business, net income generated by the business, that have been retained in the business. So we'll come to that in just a few minutes. This shows you the accounting equation. This equation needs to be memorized at this point because we're going to use this throughout this course. For every transaction we have, for every point in time in the business, the assets of the business must always equal. They must always equal the liabilities plus stockholders' equity. If for some reason this equation is out of balance, it doesn't equal, there's an error someplace. Something's wrong. So you have to go back and correct it. But use this accounting equation, even though this is another version, you're just subtracting liabilities from assets to get stockholders' equity. That's okay. I prefer you memorize this one. Assets are equal to liabilities and stockholders' equity. Now revenues, I'm sure you know what those are. A company will provide services. It will make sales of inventory to customers. Those are revenues. The customers and clients will be paying the company, and we report that as revenue in the income statement. Expenses, you know what those are. So in the business, you'll have rent possibly. You'll have the cost of the inventory that you sold, utilities, insurance, taxes, a different variety of expenses. Now, once you take your revenues and subtract your expenses, then we have net income. And even though our income statements in future chapters will seem quite complicated, the income statement is still as simple as this. It's your revenues minus your expenses. That gives you net income. Now, if it happens that your expenses are more than your revenues, you will have a net loss. Okay, so hopefully that won't happen, but it might. More definitions. Dividends. I'm sure you've heard of those. Dividends are payments of part of the profits to the owners. The owners are the stockholders here. So stockholders will receive dividends when the board of directors declares the dividends, and those are usually cash payments. There can be other kind of payments, but usually cash. And this is part of the profits being paid to the owners. One thing to keep in mind is that dividends are not expenses. Some people like to put those on the income statement along with salaries and utilities, but they are not. And we'll see the statement where they go in just a minute. So you can review this when you have time, this matching example here. And let's come on down. Now, there are 4 basic financial statements. For the first major portion of this course, we are only going to be worried about the first three: the income statement, the statement of stockholders' equity, and the balance sheet. We will mention the statement of cash flows in this chapter, but we are not going to cover it in detail, so don't worry about it at this point. Just know that there is a statement of cash flows, and that's all you need to know about it. We have an entire chapter later on that covers nothing but the cash flows. The income statement, again, revenues minus expenses equals net income. So what would one look like? Here's an example the chapter has. This is a golf academy, so they've charged their clients a service revenue, golf lessons and so forth. So service revenue, $7,200. They list all their expenses. See a variety of expenses here. You add up the expenses to get a total, and now subtract the $6,000 from the $7,200 revenues. Our net income is $1,200. So it's the revenues minus the expenses will be net income. Now the heading is important. So whenever you're preparing an income statement, it's the name of the company, the name of the statement, income statement, and in this case, it's labeled time-wise for the month ended December 31st, because this company started on December 1st. So we go from December 1st to the 31st, so 1 month of income here, 1 month of expenses. So in the income statement, you always list it as a period of time. It can be for the month ended December 31st. It could be for the quarter ended March 31st. It could be for the year ended December 31st. But the income statement is always labeled as a period of time, month, quarter, or year. Let's go on down. Now a small sort of a bridge statement in between the income statement that we just saw and the balance sheet we're going to see in a minute is called the statement of stockholders' equity. Let's take a look at it. What it does is shows the beginning balance of each stockholders' equity account and the total over here, and then we show how they changed during the year. Now since the company just started on December 1st, the balances were zero. We sold stock as part of the stockholders' equity. You might wonder, well, didn't we borrow money from the bank? We raised $10,000. Yes, that's a liability. We're going to see that in the income statement and the balance sheet as a liability. It is not a stockholders' equity account. We add here under retained earnings, and this is what I talked about earlier, earnings that have been retained in the business. And the income statement we had a minute ago showed net income of $1,200. Then if they pay dividends during the year, you'll list dividends in here as a reduction of retained earnings, because dividends, again, are a payment of part of the profits to the owners. The owners want a return on their investment, so here's what we do. So the ending retained earnings balance is $1,000, ending common stock $25,000, total stockholders' equity is $26,000. Let's move on to the balance sheet. There's the equation. This is how it would appear in a formal balance sheet. Again, name of the company, name of the balance sheet, you can put it down here. And one thing different about this date as compared to the stockholders' equity, was for a period of time, and the income statement that was for a period of time, for the entire month, the balance sheet is for one date. So at the end of the day, on December 31st, how much cash do you have? It's not asking you how much cash came in during the entire month. It's just what are the balances in all these accounts at the end of the year, at the end of the day, December 31st. And so they had supplies, certain amount, receivables, equipment, various liabilities, and then here are the stockholders' equity amounts. We saw that earlier. And so we have total assets of $40,000 and total liabilities to stockholders' equity of $40,000. That's what's called the balance sheet. It must always balance. The left side must equal the right side. In the balance sheet, you notice all these different accounts, different assets, different liabilities, and so forth that we have not talked about before. Don't worry about it yet. We're going to get into that in the next chapter. But if we had all these accounts with these balances, this is what the balance sheet would look like at the end of the year. see what else we have down here. So again, balances, statement of cash flows. Again, don't worry about this. It does show you where your cash came from during the year, or the month in this case, and where it went. There are 3 sections: operating, investing, financing. Don't worry about this. We have an entire chapter later on that talks about the cash flow. So we can skip this. And this just shows you a progression on some of the numbers through the statements. We always prepare the income statement first. Why? Because we need the net income number to now complete the statement of stockholders' equity, because it will increase our retained earnings account. So we'll help get these balances, and we need these balances to now go to the balance sheet. So this comes down to here. They sort of collapse the balance sheet on us, but it comes down to here. And so always prepare the statements in this order: income statement, statement of stockholders' equity, and then the balance sheet. And we will get to the cash flow statement later, like I mentioned. A little bit of a review. You can take a look at that. What else do we have? Again, go back and read all this yourself. I'm just sort of hitting the highlights here. Let's go to the next section and see what we have. In this part, I want you to know that the accounting principles, the accounting rules that tell us how to record transactions, those are called Generally Accepted Accounting Principles, or GAAP. Yes, we do call this GAAP with 2 A's. So GAAP means Generally Accepted Accounting Principles. That gives us all the accounting rules and so forth that we have to follow to prepare all those statements. The body that prepares or comes up with those rules is called the Financial Accounting Standards Board, the FASB. Some people call this FASB. There's an international board that comes up with international accounting standards. And you can read the history if you want to. Now, auditors, each company that's publicly traded must have an outside CPA firm come in and audit the statements. What that means is the auditors will examine transactions throughout the year. Not every transaction, but they will select some for review. They'll still do quite a few. And then they will see if all the items were recorded correctly. They'll see if the statements were prepared correctly. And then the CPA firm will express an opinion on the financial statements. Were these prepared according to GAAP? And do they fairly present the financial position of this company? That's what the auditor is trying to do, the outside auditor. Scroll down a little bit more. They have examples here: Dick's Sporting Goods and so forth. Read this. Ethical situations in accounting. Sometimes people don't record items the way they should, and companies get in trouble. And it can get so bad as to stockholders losing a lot of money if the numbers are not presented correctly. The Sarbanes-Oxley Act, called SOX, was passed in law by Congress to oversee the accounting profession. That was done in the early 2000s. And let's see what's in the next section. Careers in accounting. For those of you maybe thinking about accounting as a major, there are a variety of possibilities that you can have as a career in accounting. Public accounting is working for a CPA firm. You can do audits, be an auditor, be a tax preparer, tax advisor, business advisor, just all kinds of options in public accounting itself. You can go with one of the large international CPA firms, a good-sized regional firm, or just a one-office local firm. So a variety of options in public accounting. You can go to private accounting. You can work for a company like Procter & Gamble. Any medium-sized or large company needs an accountant working for them. So numerous opportunities here. The FBI even hires accountants. The FBI does, the CIA does. They need to be able to find out about white-collar crime, build a case. If they find someone they think is guilty, then they take it to the prosecutor, and it works through the court system. Let's see what's next. Don't worry about the appendix in this chapter. Yeah, just don't worry about it. And then it gets into the back material in the chapter, and this gets into definitions, concepts, and self-study questions. These are good to review yourself. And then it gets into the exercises and problems in the back of the chapter. So that's an overview of chapter 1. So again, go back and read it yourself. Read it word for word, follow the examples through. Okay, so good luck with your studies.